Hello and welcome to Earnings Echo. We put together the most important information about Roblox. Today we are doing a deep dive into their Q1 FY 2026 numbers. And, well, if you just looked at the top line data, you'd think management would be taking a victory lap, right?
Yeah, you really would. I mean, on the surface, the backward-looking numbers were undeniably strong.
Right, but instead, the stock absolutely collapsed in after-hours trading. So today we're breaking down exactly why an apparently stellar quarter triggered this massive sell-off.
To understand the whiplash here, you have to look at the hard numbers first. Revenue hit $1.442 billion, which is up 39% year over year, and bookings came in at $1.731 billion.
Which is a 43% increase.
Exactly, up 43%. Plus, they posted a really robust free cash flow of $596 million. But, right after those numbers hit the wire, the stock just plummeted.
Yeah, it crashed 21.5% in after-hours trading, down to, what, $43.40?
Right, $43.40. That basically wiped out 18 months of daily active user-driven gains in a single session.
I mean, that is brutal. How do you beat consensus so soundly on revenue and bookings, yet lose a fifth of your value overnight?
Well, the market price is in the future, right? And management just delivered a catastrophic update to their forward guidance. They slashed their FY26 bookings growth forecast down to a range of just 8 to 12%.
Wait, 8 to 12%? We really need to put that deceleration into perspective for you, the listener. Going from explosive growth to the low teens isn't just a slowdown, it is hitting a brick wall.
Oh, absolutely.
I mean, in FY 2025, Roblox was posting 55% bookings growth. Dropping to that 8 to 12% range completely rewrites their growth narrative. What operational roadblocks actually caused them to hit the brakes this hard?
The primary headwinds are coming from structural friction that they recently introduced to the platform. They executed a global rollout of mandatory age checks and new AI-driven chat filters.
Which obviously adds major friction.
Exactly. Every extra step in an onboarding process increases abandonment rates. So these new requirements actively stalled new user acquisition and really diluted engagement metrics across the board.
And didn't they also have geopolitical issues?
Yeah, you add in the December 2025 platform ban in Russia, which sequentially suppressed daily active users, and the whole growth engine essentially choked.
It sounds like they installed heavy speed bumps on a digital highway. You need them for long-term safety and compliance, but they are absolutely lethal to short-term velocity.
That is a great way to put it.
But let me challenge their strategic pivot here. To offset this slowdown, management is aggressively targeting the over 18 demographic, right? Specifically by raising the U.S. over 18 DevEx creator payouts to 37.8%. Is pivoting a heavily gated kids platform to mature gamers actually realistic?
Well, management certainly believes it's the required foundation. Listening to the tone of the earnings call, executives were defensive but very resolute.
Defending the friction, basically.
Right. They are framing these severe short-term headwinds as the painful but necessary cost of building a safer, highly ad-friendly platform. By increasing that DevEx payout to 37.8%, they're directly manipulating the financial incentives.
Because developers follow the money.
Exactly. This payout is designed to motivate creators to build novel, mature games that will naturally attract an older, higher monetizing audience.
So essentially bribe the developer ecosystem to age up the content. Let's see if Wall Street actually buys that strategy. If we look at the valuation, what growth expectations are actually priced into this new $43.40 share price?
We can strip away the market noise by looking at a reverse discounted cash flow analysis. Now, a reverse DCF isn't an exact science, but it acts as a decoder ring, revealing exactly what assumptions the market is baking into the current price.
Okay, so what does the decoder ring say?
At $43.40, the market is implying a 14.2% revenue compound annual growth rate over the next 10 years, along with a target 20% free cash flow margin. Crucially, the model implies a bookings KNGR of exactly 9.4%.
Wow, 9.4%, which aligns perfectly with their lowered 8 to 12% guidance range.
Right, it is completely baked in.
But if the market is pricing in a 9.4% bookings CAGR, does that mean Wall Street has officially declared Roblox's hypergrowth era dead?
Yes. I mean, the data indicates exactly that. The market is repricing the stock for a new, lower growth normal. The massive valuation premium Roblox enjoyed during its hypergrowth phase has compressed significantly to match this reality.
Bringing this back to our core echo for you today, Roblox is undergoing a highly painful structural transition, but based on that reverse DCF, the current valuation actually isn't fundamentally disjointed.
Yeah, provided they can maintain that low teens growth while executing this pivot.
Right. And the provocative thought to leave you with today, that a dynamic you need to monitor, is whether these strict, parent-approved safety features can paradoxically succeed in attracting the high-spending, mature adult gamers that Roblox desperately needs to fuel its next decade.
It is going to be an incredibly difficult needle to thread.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.